While we're waiting, if you have any questions.
Yes, Professor.
Yeah.
Do you know at what page this starts in the packet?
9. We're on page 8 in the packet last week, so we'll start on page 9 today.
Okay, thank you.
Okay. But we're going to start with that start of the class test as always. So this is not from your lecture notes. It's like a test before we start. Okay, folks, it is time. So I'm going to get started and we're recording. Any questions before we start generally about the class issues? Yeah. So you saw my Airbnb valuation? And I could not, I mean, I couldn't even get close to the price. So hopefully you'll have more luck with that than I do. No, but read the post first. Don't just go into the Excel spreadsheet because it'll at least give you a sense of the landscape, with what you're going after, how, because otherwise you're going to be playing with growth rates for no reason at all, doubling growth rates, quadrupling growth rates. So it'll at least give you some perspective. Right? And let's see if we can get as many on this as we did on the. I was very happy with the GameStop valuations. We got almost 300 people on the bandwagon. So let's see how many we can get on the Airbnb. So let's talk a little bit about what today is going to bring. Today we're going to complete our setup for how do different discounted cash flow models work, what's common across them, what's different. But we're going to spend a lot of today talking about risk-free rates. So I'm going to start with a few questions about risk-free rates, and I'm going to make each of you be my guinea pig. So don't feel badly if I put you on the spot. I'm not trying to make you feel small or wrong. I just want you to try to figure this out with me, and I'll help you along. So Ricardo, you're going to be my first guinea pig. Ready? Unmute yourself.
Yep.
So here's my question. You're valuing a Brazilian company in nominal Brazilian reais, right? And you have to, and I'll tell you the numbers. The risk-free rate in reais is 7.5%. The risk-free rate in US dollars is 2.5%. If I just ask you a generic question, I mean, this is a Brazilian company, the risk-free rate is 7.5% in reais, 2.5% in dollars. Which currency would you expect to give you a higher value for the company?
I think you'd have a higher value with the Brazilian company.
No, it's the same company. Your choice is, do I want to value it in reais or dollars? And the only difference between the two is one has a 2.5% risk-free rate, the other is a 7.5% risk-free rate. How does the risk-free rate play out in valuation? Where does it show up?
It's in the cost of capital.
It's in the cost of capital. So lower risk-free rates create lower discount rates. And in discounted cash flow valuation, if you carry this to the next step, lower discount rates create higher value, right? So this is a very commonly held misconception. People actually say, well, if I value a company in US dollars, I should get a higher value because the discount rate is low. One of the things we're going to talk about today is why that's not true. Because if that were the case, what would we do? We'd value every company in Swiss francs. Why even go to the US dollar? The Swiss franc risk-free rate is minus 0.5%. Clearly, there's something else we're missing here, and we'll talk about what that is. Now, incidentally, staying in Latin America, if you think about, about valuation, Latin America remains one of the few parts of the world where people still value companies in real terms. You know what that means? You take inflation out of the cash flows and you take inflation out of the discount rate. So you value a company in real terms as opposed to nominal real US dollars. Sriram, I'm going to put you on the spot. Would I get a higher value or a lower value when I do things in real terms?
Probably get a lower value.
First, if I do things in real terms, my risk-free rate has to be a real risk-free rate, right? Because I do everything in real terms. Well, a real risk-free rates are going to be much lower than any nominal rate because you're taking inflation out. So if you use the same logic I did for the dollar, not only should my company be worth more in dollars, if I value in dollars than in reals, it should be worth even more if I do things in real terms rather than nominal terms. And that, again, is a very dangerous place to be because it means I can play games, right? I can change my discount rate from one currency to another, and from every currency to my value should be kind of bouncing around. And we don't want that to be true. So at the end of today's session, you revisit these questions. I want you to be able to look at those questions and say, you know what? Now, I know the answer to that question, but kind of put it in the background. You're saying, how can that be? How can value not change as I move across currencies from nominal to real? We'll talk about it. Kimberly Fang?
Yeah.
Unmute yourself. Okay. You know what the T-bond rate is right now? Give me a rough sense. Where is the 10-year T-bond rate?
Around 1%.
1%. Is that historically low or is that historically high?
Probably it's historically low.
It is the lowest it's been in 100 years. Right? And when people, if I ask you why is the risk-free rate low, and I'm willing to open this up for a discussion, my wager is most of you will say the Fed did it. And if you watch CNBC, you read, the Fed is what's keeping rates low, right? But is that true? Is it the Fed that's been keeping rates low? I mean, everybody seems to be telling me that. But does the Fed have that much power? Jake Lackman, what do you think? Can the Fed keep rates low if it wanted to? I mean, Jerome Powell must be a superhuman.
I mean, I think so, but you're making it seem like it's another person or entity, so.
Have you guys ever been on the tour of the Federal Reserve? You go downtown. I know it's probably shut down because of COVID, but about 4 or 5 years ago, I took went with my wife and my 2 youngest kids. They've all graduated. They moved out so they're not forced to do this anymore. We went on a Federal Reserve tour. You can actually get a tour of the Federal Reserve. So you go downtown. It's a building actually right by Maiden Lane. It's that in that section of downtown. It's this big, very, very impressive looking building. It looks like a fort. You walk in and this guide comes who takes you on the tour. And the guide was about 23 years old, a nice perky person, but I almost made myself persona non grata the moment the tour started. And the question I was going to ask her is, could you take me to the interest rate room? Because if you listen to CNBC, that's the vision you get, right? Jerome Powell or Ben Bernanke or Janet Yellen must have a room where they go in and they said, you know what, the T-bond rate looks too high. Let me move it a little bit. Oh, the T-bill rate looks too low. Let me move it a little bit. This might require a level of detail that you don't feel comfortable. But Jake, do you know the only interest rate the Fed actually sets? There's only one rate the Fed actually sets. You know what that rate is called? Thomas, what's that rate called?
The Fed manages something called the Fed funds target rate.
The Fed funds target rate. And what does the Fed funds target rate represent?
It's like the interest rate that it charges in the discount window, like when the
And who
because
can
Fed
go to that? And who can go to that window? Can you and I go to that window and say, "Can you lend me some
no
money?"
only the banks, like the
Okay, so
primary
it's
banks can.
basically a rate that banks can borrow and lend money overnight. That's it. That's the only rate the Fed set. It doesn't set the T-bill rate, it doesn't set the T-bond rate, and it definitely doesn't set your student loan rate, your mortgage rate. Listen, but it influences rates. One of the things we're going to talk about is how little influence the Fed actually has. We're actually going to talk about the truth, why rates have been low for the last 10 years. And guess what? The Fed has been a player, but it's a side player. And the reason this becomes an issue is you heard of the Federal Open Market Committee. That's a committee that meets every few months. It sets policy for the Fed. And if you've ever worked on Wall Street, the entire market shuts down on the day those committees meet, and everybody waits with bated breath for, hey, what will the committee decide? Will they let rates go up or down? We talk about the pointlessness of that, how little you're really learning. Which leaves me with one final issue people have been struggling with for the last 5 years. You remember Econ 101 class and people describing interest rates. Interest rates are always positive. That's the way I was taught interest rates. I'm sure that's, so when people talk about, trading off current for future consumption, you have to pay a rate. That's what an interest rate is. So in textbooks, interest rates are 1%, 2%, 5%, 7%. And the reason I bring that up is about 5 to 6 years ago, interest rates in some currencies, the risk-free rate, became negative, and it freaked people out. They said, how can this be happening? It's impossible. One of the things we're going to talk about today is why that's not impossible. It's improbable, but not impossible. And what to do when rates have turned negative. So if you're having a company in euros or Swiss francs or Japanese yen and the risk-free rate is negative, what should you be doing? Because here's what some people do. They replace that rate with what they call a normal rate. And now we're in very, very dangerous ground. Nick, for Brony, T-bond rate right now is 1%. If I ask you what's a normal T-bond rate, what kind of number would you give me? What's a normal?
You asked me? I have no clue. Maybe higher than 1%, 5%. I'm not sure.
Yeah, and in fact, most people, when they think about normal, what do they look at? They look at the past, right? How far back? Depends on how old you are. I tell people, you tell me what you think a normal risk-free rate is. I can tell you how old you are. Because if you tell me a normal risk-free rate is 2 to 2.5%, you probably joined the market in the last 10 years. If you tell me it's 4%, you probably came to the market 20 years ago. If you tell me it's 6%, you've been around too long, you should retire. Probably came in the 1980s. Normal is in the eye of the beholder. So when people say the normal rate is, you have to pause right there and say, where the heck do you come up with this normal? Because if I went around this room, you could be making up 2%, 5%, 4%. Well, because this is something I see increasingly in valuation, people replacing the risk-free rate with what they call a normal rate. I think it's an extraordinarily dangerous practice for lots of reasons, but we're going to come back and talk about that. So I'm going to close these slides and go back to your lecture note packet. So if you have the first packet, great. If not, get it soon because we're well into the packet now. So turn to page, I think we're page 8 of the packet. Because that's where I left you. I talked about how you can value the equity. You can either value the firm and subtract out debt or value equity. And if you do it right, you will get the same answer. At the end of today's class, I'll send you a weekly challenge. And every week for the next 12 or 13 weeks, you get this challenge. It's not a big deal. It's completely optional. And I want you to try it because basically in this week's challenge, I'm going to ask you to deal with this question of, will you get the same answer? But let's talk about what it is about this process that gives the same answer. And initially, I'm going to cheat and give you a kind of made-up example. Let's suppose I came to you with a business and I gave you 2 sets of cash flows. So basically, if you look at the second column, you see cash flows to equity, cash flows left over after debt payments. And in the fourth column, you see the cash flow to the firm. So notice the cash flow to the firm is higher than the cash flow to equity because you're adding in the cash flows to lenders and debt holders and bond holders. What is the rule? If you have cash flows to equity, your discount rate has to be a cost of equity. If you have cash flows the entire business, your discount rate has to be a weighted average of your cost of equity and cost of debt, which is a cost of capital. So I'll give you the inputs. This company's cost of equity is 13.625%, third decimal point. Its pre-tax cost of borrowing is 10%, but it's got a 50% tax rate. What does that mean? Because you get the tax benefit from debt, a 10% pre-tax cost is essentially equivalent to a 5% after-tax cost of debt. So equity costs at 13.625%, debt costs at 5%. This company's equity is worth $1,073 million. Its debt is worth $800 million. I know it's a lot of numbers I've thrown at you, but I'm actually going to value this business twice. The first, here's what I'm going to do. I'm going to take cash flows to equity, cash flows after debt payments, and discount them at the cost of equity. Cost of equity is 13.625%. What I get as a present value is $1,073 million. This stock is fairly priced. That's with equity cash flows, discount the cost of equity. What's the alternative? I could take cash flows to the firm and discount at the cost of capital. But first, I have to compute a cost of capital. And here's how I compute it. I take the cost of equity, 13.625%. I weight it by how much equity I have, $1,073 million. I take the cost of debt, 5% after taxes, and I multiply it by the amount of debt I have. My weighted average cost of capital is 9.94%. So I take the cash flows to the firm, pre-debt cash flows, discounted 9.94%. What I get as a present value is $1,873 million. What do I need to do to get to value of equity? I need to subtract out the debt, $800 million. I get a value of equity of $1,073 million. Remember, in geometry, once you prove something, you write QED. I don't even know what that stands for. For Latin, I proved it. If you are consistent, the value of equity you get with these approaches will be the same. Now, can you see the potential for screw up here, though? You saw that with the Kennecott case. The Kennecott case, what did I do? I mismatched the cash flows to the discount rate. So I'm going to re-emphasize that point. When you're doing discounted cash flow valuation, the cardinal sin, if any of you, I mean, I'm not a Catholic. When I first was, my wife is Catholic and I go to church, I remember the priest would talk about cardinal sins. And I turned to my wife and said, what's a cardinal sin? She says, the kind of sin you can't come back from. You can't go to. So there are sins in valuation where you can confess and I'll forgive you. But there are sins in valuation where if you do this, no, there's no forgiveness. You're doomed. You're into valuation hell. The cardinal sin in valuation is mismatching your cash flows to your discount rates, because then all is lost. Let me give you an example. Take that valuation that I just did. If I'd taken cash flows to equity, which are after debt cash flows, and discounted them back at a cost to capital, I'm doing what First Boston did, right? I'm going to overvalue the equity. Why? Because I've used too low a discount rate for those cash flows. If I take cash flows to the firm and discount them at the cost of equity, I'm going to come up with too low a value for the business because I've used the wrong discount rate. If you get a chance, put an X on this, because if you're looking at these pages afterwards, reviewing, this is what you're not supposed to do. Don't mismatch cash flows to discount rates. So with that setup, let's think about how you can structure a discounted cash flow valuation. I'm going to take you through a 5-step process that we're pretty much going to follow in coming up with discounted cash flow valuations. We're going to start with discount rates. Why? Because the discounted cash flow valuation might as well start at the source. We're going to talk about how to estimate real and nominal, how to deal with different currencies. Second stop, before we get too ambitious, I'm going to talk about how we get from accounting numbers to cash flows. Because let's face it, when you look at financial statements, you're getting an accountant's vision of the world. We're going to talk about how to get from there to cash flows. The third step is where we get ambitious. We talk about the future. What are the cash flows in the future? What's growth going to be like? Fourth step, we put closure. Why? Because publicly traded companies in theory can last forever. So at some point in time, you've got to shut things down and say, this is what my company is worth in year 5, year 10. It's called a terminal value. Discount rate, cash flows, growth rates, terminal value. And in doing all of this, we're going to follow the principle we talked about in the very first class, the principle of parsimony. Less is more. If you can value a company with 3 inputs, value it with 3, don't use 5. If you can value it 2 years of forecast, do 2, don't do 10. We're going to find the most parsimonious model we can for a company. Now, we're going to embark on this process where you're going to get very quickly confused. We're going to talk about different discounted cash flow models in a dividend model, free cash flow to equity, free cash flow to the firm. So I'm going to give you some perspective, because as we go through these models, you're going to say, there are so many different models. How the heck am I ever going to understand all these models? Actually, they share a lot more than you realize. Because if I were to draw a picture of a discounted cash flow model, a generic discounted cash flow model, here's what I have. I have my starting point. What did you have as cash flows last year, right? I have a growth in those cash flows. I have a discount rate and closure in the form of a terminal value. And what I get as a present value is the value today. Every DCF model, you see this. Now, what's different across these models is how you estimate the cash flows, how you get the growth rate, what you use as a discount rate. I'm stating the obvious, but those are the places, they're all discounted cash flow models. What's different is how we come up with the numbers. And broadly speaking, here are the 3 ways you can structure a DCF. You can say the only cash flow I get is dividends, in which case you're thinking like an equity investor, right? You project out dividends because that's what you receive. Your growth rate then will be growth in dividends. Your discount rate has to be a cost of equity. Dividends go to equity investors. And what happens in steady state will be dividends will grow at will give you a value at the end of year 5 or 10. Everything is about dividends. The problem though is companies don't always pay out what they can afford to in dividends. We know this with absolute certainty. How do we know that? What gives companies away? Because you ask a CFO of a company, are you paying out what you can afford to in dividends? They almost always say, oh yeah, of course. If Google CFO says, look, we're paying out what we can in dividends, you know he's lying through his teeth. And there's a very simple thing you can point to and say, that shows me you're lying. Angela Wang, can you help me out here? So how do we know Google is lying when they tell you that they're paying out what they can afford to in dividends?
So I'm totally going to take a guess, but since the stock price is the present value of the dividends, the fact that the stock still has a price, does it mean that they're not paying all the cash out?
Well, if I'm Airbnb and I say, look, I can't pay dividends, even though their stock price is high, they're not lying. Why? Because they don't have the cash flows, right? So the stock price being high is a factor. So I'm not saying it's not, but it's got to be something more tangible, right? Which is you had cash you could have paid out that you chose not to pay out. Is there something in the balance sheet that gives them away?
Yeah. Is it
What is it?
earnings?
Retained earnings? Actually, you're close. Go to the other side of the balance sheet.
Oh.
What's the item on the other side of the balance sheet that reveals that you could have paid dividends?
Oh, is it cash?
There you go. How much cash does Google have? $100 billion. $100 billion. Don't keep telling me you paid out what you can do. That's not manna from heaven. It didn't show up magically on your balance sheet. It's a direct consequence of you choosing not to pay dividends. So if I value Google with a dividend discount model, given that they don't pay dividends, what am I going to conclude? It's worth nothing, which is absurd. We can argue what Google is worth, but it's definitely not worth nothing. So I'm going to give you an alternative. Is there a way I could compute what Google could have paid in dividends last year, a potential dividend? Is Drava? Am I pronouncing your name right, Drava?
Dravka, but you can call me
Dravka.
Zuzi.
Susie,
Yeah.
okay, if I remember. Okay, so if you're looking at, can I compute what Google could have paid out in dividends last year?
Through the cash that they have, the cash flows.
Or the cash flows left over after they've met every conceivable need, right? After investments, if you have cash left in the till at the end of the year, it is cash you could have paid in dividends. And you know what? I can compute that. You go to the statement of cash flows, I can see what your operations brought in, I can see what you invested, I can see what you used to pay off debt. And at the end of the process, you know what? You had $15 billion left over. You chose not to pay it in dividends, but it is potential dividend. I know we attach fancy words in finance. You know why we do it? Because it makes the rest of the world feel stupid, because we can throw these words at them to intimidate them. But this is an inside story. I'll give you the word you can use to intimidate, but I'll give you what it actually measures. You can say, that's not such a big deal. I'm going to call this free cash flow to equity. It's free because you've met every conceivable need. It's a cash flow because it's coming from the statement of cash flows, and it's to the equity investors in the company. The free cash flow to equity for Google was 15 billion. It chose not to pay that dividend. So you know what I'm going to do? I'm going to value the company on potential dividends. And I get a lot of pushback on this. They say, but if they don't pay it to me, why am I counting it? When Google has 100 billion in cash and you own shares in Google, technically, you know what you have? A slice of that cash. Don't try to do anything stupid with this, like write checks against Google's cash balance. It's not going to work for you. But as a shareholder in Google, you own a piece of that cash balance. And you know what markets do? They feed that into your stock price. When you pay for Apple, remember that Apple stock price embedded in it has the $250 billion in cash that Apple has as a company. So in free cash flow equity, I replace dividends with potential dividends. Growth in dividends with growth in potential dividends. A lot more work because I'm now estimating those numbers. But I still use the cost of equity because I'm looking at cash flows to equity. Which brings me to my final way we can do DCF. Instead of focusing on just equity cash flows, I can look at the collective cash flows you make as a company, right? Free cash flows equity plus interest plus principal. It's called free cash for the firm. If that is the cash flow I'm estimating, the discount rate I would use would be the cost of capital because it's a weighted average. And what I value would be the entire business. Same structure, but different cash flows, different ways of thinking about growth, and different discount rates. So let's start easy. The oldest discounted cash flow model that I know of is the dividend discount model. The dividend discount model, dividends are your expected cash flows, your discounted is the cost of equity, what you get as a present value is the value of dividends. In fact, Angela said the value of a stock, and that's the way we've always thought about stock. It's the present value of future dividends. But if I take that model and replace it with free cash flow to equity, all I'm doing is replacing actual dividends with potential dividends. The rest of the model looks exactly the same, right? You discount the cost of equity, what you get as a present value will be the value of equity. So when you go from dividend discount models to free cash flow to equity models, all you're doing is replacing actual dividends with potential dividends. And if you have a company, a very rare company that pays out exactly what it can afford to as dividends, guess what? The two models will give you the same price. And of course, the final variant is instead of looking at these cash flows from an equity perspective, you look at the whole business, you look at the collective cash flows you get, cash flows before debt payments. You discount them back at a weighted average of what it costs you to raise money from both equity and debt. And what you get as a present value will be the value of the entire business. What I'm trying to do is tell you that when you think about all these different models, go back to the source. You're not doing something different. You're just taking a different perspective. And that different perspective gives you different inputs, but they're all discounted cash flow models. In fact, I get a lot of questions from people on, should I use a dividend discount model or a DCF model? And the risk of being hated, I say, well, a dividend discount model is a DCF model. Only thing that's different is how you define cash flows. So DCF is a generic term. How you estimate cash flows and discount rates might give you different models. So now let's embark on discount rates. We're going to spend at least probably 4 or 5 sessions on discount rates. Some of this might be review if you've taken a corporate finance class. Some of it I might be replacing what your corporate finance professor told you should do with what I think you should do. And at least for this class, I would strongly recommend that you do what I suggest you do, not what your corporate finance professor told you should. But let's start with what seems like an obvious statement. Do discount rates matter in a discounted cash flow valuation? Of course they do. That's why it's called discounted cash flow valuation. Having said that though, I'm going to say something odd. Given that I have 5 books on valuation, multiple chapters on discount rates, I think we spend way too much time in a discounted cash flow valuation coming up with discount rates and way too little time talking about cash flows. I know, I've seen bankers value companies, and if you ask me, bankers shouldn't even try to value companies because they do kabuki dances of all kinds. But 80% of their time is spent estimating discount rates. And I think that's a mistake. I'll back that up later in the class, but it's a mistake. But the key thing to remember about discount rates is that you stay consistent. Consistent in what sense? You pick the currency for your cash flows, your discount rate has to be in the same currency. You decide to do your cash flows in equity terms, your discount rate has to be a cost of equity. If you decide to go real, that's fine. Your discount rate has to be a real discount rate. Match your discount rate to your cash flows. So let's set up the picture, what goes into a discount rate, and then we'll start talking about inputs. When you think about what your cost of equity is in a company, the starting point is always a risk-free rate. You have to ask, what would I make if I were guaranteed a return in this currency? Jessica Manak, should that be easy to get, you think, a risk-free rate?
Yeah.
It should be the easiest, right? I remember when I did my MBA, we spent 15 seconds on the risk-free rate. You know what I was told? I was told to use the US Treasury rate as my risk-free rate and moved on. Shows you how dollar-centric my MBA class was and how little we thought about risk-free rates. I'm going to modify your answer. It is easy in some currencies, much more difficult in others. Can you imagine trying to get a risk-free rate in Venezuelan bolivar? You could be spending the rest of your life and not get an answer. Starting point is a risk-free rate. Second, you need a measure of relative risk. Is my company more risky or less risky than the average company? What's a number that we use? You've seen this number. It becomes part of finance religion. What is the number that measures the relative risk of a company? Jessica, you can stay on this part. What's the number that we use to measure the relative risk of a company?
Sorry, what was the question? What's the number that we use?
So when you look at a company and I say this company is riskier than others, there must be some metric we use to measure the riskiness of companies relative to each other. What is the number in valuation that measures the relative risk of a company?
Oh, do you mean like the cost of capital or the?
No, we get a cost of capital, but you need this number to get there. I'll give you a clue. It's in the Greek alphabet.
Oh, beta.
And we make a religion of this, right? We act like we've invented something. What is a beta? Beta is a measure of relative risk. When you tell me a stock has a beta 1.2, you're telling me it's 1.2 times more risky than the average stock in the market. The fact that you got it from a regression, you got it from Bloomberg, who cares? It is a measure of relative risk. And finally, you need a price of risk. What are people demanding for investing in equities collectively? That's called an equity risk premium. Risk-free rate, beta, equity risk premium. The next couple of sessions are going to be built entirely around getting those 3 numbers. But before we go down that path, though, I'm going to argue that not all risk is created equal. We think if we take risk, we should be rewarded. And people do some really stupid things based on that. They say, I took a lot of risk, I should get a high return. Depends on what kind of risk you take. If you decide to buy a house across a 6-lane highway from a broker, and every morning you get up and you run across all 6 lanes to get to that broker, and you say, look, I took a lot of risk, I should earn a high return, right? I'm going to say, not really. So I'm going to break risk into buckets. And I'm going to give 3 categorizations that'll help you think about where risk comes from. When you think about valuing a company, okay, the risk you face can be either estimation risk or economic risk. You say, what's the difference? Estimation risk you can make go away by collecting more data, by doing your research. So if I were valuing Airbnb, you know the estimation risk is I don't know the size of the hotel market, I don't know what they charge when they rent a house out. That's estimation risk. And if I do my homework, estimation risk can be made to go, if not to 0, to a very low number. You know what economic risk is? It's risk that has nothing to do with your homework. What are some of the risks that Airbnb faces? Anybody? Come on. You don't have to do, I mean, this is not a finance question. It's a question of business risk. What's the biggest challenge that Airbnb faces?
Regulatory
Regulatory, right? Because there are some cities where they've been banned. In New York, for instance, that banned Airbnb because they couldn't collect taxes. It's a regulatory issue. You can do all the research in the world, but you have no idea what's coming down the pike. What I'm trying to do is soften the blow for you, because some of you are operating under the presumption that if you go out and work harder, collect more data, that you're going to feel more certain about the future. Let that go. Because all you're doing is getting rid of estimation risk, and 90% of the risk in most companies comes from economic uncertainty. Estimation versus economic. Here's the second grouping. The uncertainty can be micro uncertainty or macro uncertainty. Let me explain the difference. Micro uncertainty comes from things the company does, which might be better or worse than expected. The case of Airbnb, since we're talking about Airbnb, the micro uncertainty can come from the relationship between Airbnb and the host. You know how the Airbnb business model is Airbnb is really an intermediary. You have hosts and you have guests, and it connects the two. And it needs to keep both sides happy. And it's in a sense a tough challenge, right? Because as a guest, you want to minimize what you pay. You don't want to pay the additional amount. And as a host, you want to collect more. So it has got to, and to the extent that it does a good job, you're going to make profits. And if it doesn't, you're going to be in trouble. That's micro uncertainty, uncertainty about the business model, how it will play out. As opposed to what? A big deal on what happens to Airbnb this year and next year is whether the shutdown ends and whether we, I mean, let's face it, as long as we're shut down and in our houses, we're not flying all over the place. At least I'm not renting places. So for Airbnb, the macro uncertainty, will the shutdown end? How will the economy do? You think, who cares? The first kind of risk, micro uncertainty, is risk that you can average out if you have lots of stocks in your portfolio. Because for every company that does worse than expected, another company will do better than expected, things will average out. But macro uncertainty, you can hold every company in the market, and the economy doesn't reopen this year, you're going to be in trouble no matter how diversified you get. What risk you build into your discount rate will depend upon whether you take the perspective of a diversified investor who can basically spread their bets, or whether you take the perspective of somebody who's looking at only one company. And finally, uncertainty can be continuous uncertainty or discrete uncertainty. Continuous uncertainty, you're exposed to every moment of every day. So inflation goes up, down, you're affected every moment of every day. Exchange rates change, affected every moment of every day. As opposed to what? Let's say you operate in a part of the world where nationalization is a very real threat. You could get nationalized, right? If it happens, the whole company ends. That's discrete uncertainty. We're very good at dealing with continuous uncertainty in finance, not that good at dealing with discrete. And one of the things we're going to talk about in this class is, how do we bring it in? In fact, I'm going to value Aramco. Aramco should be the easiest company in the world to value. You're familiar with Aramco, right? Where does its value come from? The fact that it has 300 million barrels of oil under the Saudi sands, and all you need to do is stick your finger in the sand and oil comes out. Access to really low cost reserves. When value Aramco, so if I valued Aramco as an oil company, it's easy. Just take oil out, sell it, get the cash flows, discount it back. But what's your biggest risk when you invest in Aramco?
OPEC.
Oil prices could change. You can deal with that. What's the biggest risk? FA?
Sorry, I thought you were asking a question. Sorry.
Yeah. What's the biggest risk you face in Aramco? It's not that oil prices are moving. After all, Aramco is in fact has the lowest cost reserves in the world. So it's going to be okay, even with oil price at $30 a barrel.
The demand for oil?
That too, I mean, that shows up in the price, right? The demand for oil is in the price, and if you have the lowest cost reserves, you're going to be able to sell your oil before everybody else does. Think out of the box.
Perhaps OPEC. Someone else said this in the chat too, but OPEC's kind of regulatory decisions on how much can put out.
There is no OPEC left. OPEC is a shell of itself, right?
You're
Let
just
me ask you a question. What is Aramco? You think of it as a publicly traded company, but it's Saudi Arabia Inc. Do you know that 80% of Saudi Arabia's GDP comes from oil, and Aramco sits on that oil? But let's dig a little deeper. Who does Saudi Arabia belong to? You think the Saudi Arabians? Well, in a loose sense, Aramco is an extension of the Saudi royal family. Let's face it, if tomorrow you have the equivalent, remember what happened in Egypt 12 years ago? If that happened in Saudi Arabia next year, do you think this oil under the ground is going to bail you out? Your company could, in a sense, kind of crumble to pieces if you had a regime change, especially if it's a violent regime change. I'm not forecasting, so don't go out as a model predicts, Saudi Arabia. No, I'm not saying that. I'm saying when you value Aramco, you have to bring this in. That is discrete risk. So with that structure, let's talk about what it is that we try to embed in the cost of equity. So we've looked at all these different risks. Not all risks get built into the cost of equity. If you're a publicly traded company and your marginal investors, the marginal investors are investors who hold a lot of stock and trade that stock, tend to be diversified. The only risk that gets built into your cost of equity is risk you cannot diversify, macroeconomic risk, market risk. Micro risk gets diversified away. You're saying, what if my investors are not diversified? Then we can talk about you're more like a private business. But this is, I think, the central question of how we think about risk and return models in finance. Are investors diversified, in which case they care only about market risk, or are they not, in which case they care about total risk? Now, we could spend the rest of eternity talking about risk and return models in finance, but I have neither the time nor the inclination to do it. I'm going to summarize everything I know about risk and return models in finance on one page. This is every risk and return model you run into. The oldest risk and return model in finance is the CAPM. In the CAPM, we measure the risk you cannot diversify. That's what betas measure. They measure the risk you cannot diversify away. And we come up with an expected return as risk-free rate plus beta times equity risk premium. The CAPM came out in 1964. For 14 years was the only game in town. Then came the arbitrage pricing model, a model that says, if we care about market risk, why should we all capture it in one beta and one factor? Why don't we allow for multiple market risk factors and multiple betas? But the betas are unspecified. It's a statistical model, factor 1, factor 2, beta 1, beta 2. And then a little later after the arbitrage pricing model came what were called multi-factor models, where you try to put a name on each factor, interest rates, the yield curve. And then in the last 20 years, you've had a push towards models that are data-driven, where you don't even try to build a risk and return model. You look at what kinds of companies earn high returns and what kinds of companies earn low returns. And that becomes your basis for thinking about cost of equity. So if you look at the last 100 years, small companies tend to earn higher returns than larger companies. Companies with low price to book ratios earn higher returns than high price to book ratios. And these models, you basically take the size of the company and its price to book, you come up with an expected return. I call these proxy models, but something else stands in for risk. But in every one of these models, if you think about the inputs, here are the inputs you will need. You need a risk-free rate. You cannot value companies if you don't have a risk-free rate. You're already in no man's land. You need a measure of the price of risk, an equity risk premium, and you need a beta or betas. And that's how I'm going to sequence the next part of this class. Is we're going to start with what should be the easiest of these numbers, which is the risk-free rate. So you ready? Let me give you my definition of what a risk-free rate is, and you're already going to see why it's more difficult than it looks. On a risk-free investment, you know exactly what you're going to make with certainty. Let me repeat that again. You know exactly what you're going to make with certainty. And already you can see that when you think about something being risk-free, the entity issuing that security cannot have any default risk. Even if you have a tiny bit of default risk, you cannot be risk-free. And second, when you talk about risk-free rates, you have to tell me over what time horizon. You know what I mean by time horizon? The risk-free rate over a 1-year time horizon can be very different from the risk-free rate over a 10-year time horizon. So I'm going to put something on the table. If somebody asks you, what is the risk-free rate? Never answer the question until it's qualified. With what? In what currency? Because obviously there are different risk-free rates in different currencies. And over what time period? So if you ask me what's the dollar risk-free rate, I'm going to say fine, but over what period? First, what dollar? US dollar, Australian dollar, Singapore dollar, you have to be specific. And second, over 5, 10 years, because the answer is going to be different depending on how that question is framed. Now, when I was taught valuation, it's still in many valuation classes around the world. You know what you're taught? To get a risk-free rate in a currency, just look up a government bond denominated in that currency. So you want a US dollar risk-free rate, look up a US government bond in dollars and use that rate. That's what we do, right? T-bond rate. But be very careful with that advice, because not all governments are default free. Let me give you an example. Let's suppose you wanted a risk-free rate in Brazilian real. And I gave you a Brazilian government bond rate denominated in real. Don't get too excited. It is a rate, but it's not risk-free because there is default risk in the Brazilian government, even in its local currency. So what I'm going to do is take you through a series of tests. And by the end of these tests, hopefully you have a clearer grasp of what exactly a risk-free rate is. And with each one, I'm going to pick on one of you. I apologize in advance. If you don't know the answer, don't feel embarrassed, just pass it on. No. So Jonathan Moses, fam, you're first on my list here.
Sounds
You look
good.
too relaxed, so I thought I'd kind of rouse you out of your relaxation. You ready? I'll give you the easiest one of all. You're valuing a company in US dollars, and you want a risk-free rate to do your valuation. Just to give you some perspective, when you value a company in a discounted cash flow model, you estimate cash flows year 1, year 2, year 3, in fact, forever. Even though you don't show forever, that's what a terminal value is. Your cash flows keep going forever.
Right.
So with that background, which of the following would you use as your risk-free rate? A 3-month T-bill rate, a 10-year T-bond rate, a 30-year T-bond rate, a TIPS rate. A TIPS rate is an inflation-protected treasury bond, or none of the above.
I think of the 30-year treasury bond rate because it's got the longest time horizon.
Exactly. And that makes sense. Do you see why that? Duration matching. I have long cash flows. And if I had to pick just a risk-free rate, that's what I would use as my risk-free rate, the 30-year bond. But if you look at every valuation I will be doing in this class, I'll use the 10-year T-bond rate. And I'll explain why. 10-year T-bonds are issued every Monday. There's a fresh auction. You'll always get fresh. 30-year bonds are not issued as much. In fact, there were periods of time where the 30-year bond has been removed from circulation. The government stopped issuing it. Second, the 10-year T-bond is the most liquid and traded of all of the treasuries. The 30-year bond, no, kind of iffy, who's buying it and selling it. And there's a third issue. Remember, the risk-free rate is the start of my estimation, because once I get a risk-free rate, to get to a cost of equity, I need an equity risk premium. To get a cost of debt, I need a default spread. And if I define my risk-free rate as a 30-year bond, I've just made that process more difficult. And let's see why. If I use the 30-year T-bond rate as my risk-free rate, to get default spreads, I need 30-year corporates. The problem with 30-year corporates is there aren't that many. Most companies issue 10-year bonds and they stop. So from an estimation perspective, it makes my life a lot easier to use 10-year T-bond rates. It doesn't make the discount rate that different. It makes my life easier. And it's all about making my life easier. But if somebody asks you, why aren't you using 30-year bonds? Technically, they're right. I should be going with a longer-term bond. But from a practical standpoint, it just makes my life a lot more difficult to use the 30-year bond. And why wouldn't I use the TIPS rate? What's the reason for not using the TIPS rate, Jonathan?
Because the TIPS rate would kind of be tied to a shorter time period, inflation.
No, it's a 10-year. It's actually a TIPS is a 10-year bond. But what you get in a TIPS is you actually get a guaranteed real return. So when I say the TIPS rate is -1%, you actually won't get -1%. Next year, if inflation is 3%, you'll get -1 plus 3, so 2% coupon. If inflation goes to 10%, you'll get a 9% coupon.
Right, but isn't it inflation? So that changes.
Doesn't. It's a real risk-free rate.
Right.
And I'm doing things in nominal terms, it doesn't fit, because if our cash flows are nominal cash flows, I should be using a real discount rate.
Right. Okay.
So the 30-year bond would be technically the right answer, but the 10-year bond works pretty well.
Got it.
But in using all of these rates, I'm making an implicit assumption about the US Treasury, right? Cameron, what's the assumption I'm making?
You're assuming that like it's not going to default, like there is no risk.
Exactly. And that's an assumption. But I'm implicitly assuming that that's not going to happen. So let's move to the second example. Anybody valuing a European company? Come on, somebody must have. Must be. No?
Considering one, yeah.
Which one are you considering?
It's called Eigentech,
Where is it located?
based out of the UK.
Okay. We'll come back to Eigentech, but I want somebody who's picking the EU zone, the Euro, one of the Euro countries.
I guess Brexit makes it not really count anymore.
No, it's not that it doesn't count. It's a currency difference. With it's a UK company, your currency is the British pound, right? So I want to confront the Euro question first before we talk about the British pound. British pound comes with its own kettle of fish. But Marissa, I'm going to make you pick a company. I'm going to put a company on you. You don't have to do the company, but let's act like you picked the company. It is going to be Titan Cement. What is Titan Cement? It's a Greek cement company. What currency do the Greeks use right now? So if you look at a Greek company, look at its financial statements, what currencies is the statements in?
The euro.
They're in euros, right? So you need a risk-free rate in euros. So I'll find you some government bonds denominated in euros, and I'm going to give you a proliferation of riches. I'm going to find you 10 European government bonds, all 10-year bonds, all denominated in euro. And guess what? The rates are all different. So you see, look at this graph. These are all 10-year euro bonds. The rates are all different. Now you're valuing a Greek company, right? Which of these rates would you use as your risk-free rate in valuing a Greek company in euros? Sounds like it's too easy, right? You're saying there's a Greek bond here. I should use the Greek bond rate. You can't do it. You know why? Why are these rates different? They're all in euros. They're all 10-year bonds. So why is the Greek bond rate higher than the Italian bond rate, which is higher than the German bond rate? What is it that's causing these rates to be different?
Risk of default.
Risk of default, right? So the Greek euro bond is not risk-free. Why? Because it's right there in your, it's staring you in the face saying, no, I'm not risk-free. So Marissa, I'm going to come back to you. The Greek euro bond is not risk-free. That's why the rate is high. But if I want something risk-free in euros, which of these rates should I use?
Whatever.
Which government bond is least likely to have default risk in it? Just look at the numbers. If default risk pushes up the rate,
Germany, I'm assuming.
The German euro bond rate. You know what? If you're doing a euro valuation, I'm going to be valuing a Spanish company, an Italian company, a Greek company, a Dutch company, your risk-free rate is going to be the German euro bond rate. Not because it's German, but because it's the lowest of the rates. Which means 5 years from now, if I showed you this graph and the Portuguese 10-year government bond was the lowest, miracles can happen. I'd use the Portuguese government bond rate. So don't get too caught up in the German. It's because it's the lowest.
Professor?
Which actually, yeah, go ahead.
You're just wondering, like, why would someone buy a negative rate bond?
That will come back to that. But clearly people are, right? Otherwise it wouldn't be out there.
Yeah.
So clearly people are doing it. We'll come back to that because that's going to be one of the questions I'm going to ask is where do negative risk-free rates come from?
Okay.
So if you're valuing a company in euro, you're going to use the German euro bond rate. If you're valuing a Brazilian company in US dollars, Sebastian, which risk-free rate would you use if you're valuing a Brazilian company in US dollars?
I would use the Brazilian 10-year.
Dollar rate? You don't want to do that, right? A Brazilian 10-year dollar rate would be risky because you'd use the USD bond rate. Yeah. The minute you pick a currency, go to the risk-free rate in that currency. To value a Russian company, In euros, I'd use the German euro bond rate. When I actually did this in Greece 3 years ago, I used a ton cement, and I did this, and people were up in arms. First, the fact that I was using the German bond rate kind of raised hackles, right? This is Greece, they're feeling a little touchy about Germany. But the bigger problem was, we're a Greek company, punish us. And I said, you know what, I'll punish you, but it's not in the risk-free rate. Your risk-free rate has to be the risk-free rate in that currency.
Professor, quick question.
Yep.
Why is even the Greece 10-year rate lower than the US 10-year rate?
We'll come back to that. Why do risk-free rates vary across currency? The more generic question, we'll come back to that. Because if you can answer that question, you crack what I call the currency code.
Okay.
So I'm going to show you the risk-free rates in every currency, and then I'm going to ask you the same question you asked me now, and I'm going to throw it back on you. Let's see if we can reason our way to an answer.
Professor, what if there's no, like, are there currencies where there is no risk-free rate? Because
I'm sorry, if there are no, you faded away. What was the question?
That, like, what if like a country has no risk-free rate because there's always a risk of default?
Oh,
so like if you use their currency.
In fact, let's do this one. You be the, who is it that asked that question? I'm sorry, I don't see
David.
Okay, David. So you're going to be my guinea pig on this next one, because this is exactly the scenario you're describing. Let's suppose you want an Indian rupee risk-free rate. I find you an Indian government bond denominated in rupees, and the interest rate on that bond is 5.92%. You think, this is good, I have my risk-free rate. Before you use it as a risk-free rate, what do you need to check? Is there default risk in the Indian government, right? You know how I answered that question? I cheated. I went to Moody's and I looked up the sovereign ratings for India. There are two ratings that report for India: a foreign currency rating and a local currency rating. You're saying, what's the difference? The foreign currency rating is how much default risk Moody's sees in India when it borrows money in dollars or euros. The local currency rating is how much risk Moody's sees in India when it borrows money in rupees. And I prayed and I hoped and I prayed again that I would find a AAA rating under the local currency rating. Because if I did, you know what I'd have done, right? I'd have used the 5.92% as my risk-free rate. But David, stay on. Here's what I found. Moody's rated India as Baa3. It's not a horrible rating, but not a great rating. It's not a AAA rating. Clearly, Moody's says there's default risk in India. And I'll add some information. What if I told you, and we'll talk about how I come up with this number, that typically Baa3 rated sovereign bonds have a default spread of 1.95%. So David, you still there?
Yep.
The government bond rate in rupees is 5.92%, but as you said, there's default risk in India. It's not default free. But I've kind of quantified how much default risk. I've said it's about 1.95%. What's my risk-free rate in Indian rupees?
Your 5.92 plus that spread.
Plus? Do you want a plus? I'm going to give you a chance to rethink. Remember, the 5.92% reflects what you're paying for the government bond. Embedded in there is your worry about default.
Right.
So the 1.95% is, so.
We want to subtract that.
There you go. You get 3.97%. That becomes your risk-free rate in rupees. A lot messier, right? So if you have a currency where there is no default-free entity, you have to clean up the government bond rate. Now, of course, to clean it up, you need this default spread. You're saying, where am I going to get that? So I'm going to take you on a little journey on how you can get that default spread. And I'm going to give you 3 ways of doing it.
Sorry.
Question, David? Yeah, go ahead. Jonathan, go ahead.
When you say default spread, is that a similar concept to expected payout when you made the briefcase analogy in the last class?
It's close, but that's the scenario where you're investing in equity, you're making a bet. The case of a lender, let's say your bank lending out money, what's your biggest worry? That people won't pay you back, right?
Right, yeah.
If you charge them all the risk-free rate, you're going to go out of business very quickly. Because even if 90% of them pay you back, the 10% that don't pay you back comes out of your money. So what does the bank have to do? It has to take the risk-free rate and look at you as a lender and say, hey, you know what, given your history and your status as a company, I think there's a pretty big chance you won't pay me back. So I'm going to add 3% on. It's called a credit spread. Banks use it all the time to decide how much to charge you when they lend you money. A default spread is coverage for expected default rates, which will happen in the future. It's a given that people will default. You're setting aside enough money on your mortgages to cover that expected default. So it is like that risk premium, but it's even more critical because this is not even about getting an expected return. It's about making sure you stay in business as a lender.
Got it. Thank you.
Okay. So there are three ways you can get a default spread. The first is if your country has dollar or euro denominated bonds. For instance, Brazil has dollar denominated bonds. I can compare the rate on that bond to a T-bond, and that difference is a default spread. That's the first way. It's the oldest way. It's been around a long time. The second approach, you wouldn't have been able to do 20 years ago. But now, how many of you are familiar with this market called the sovereign CDS market? In the sovereign CDS market, you can buy insurance against default risk. It's a market set estimate for how much default risk there is. So let's say you buy a Brazilian bond, you're worried about default. You could go to the sovereign CDS market. And so let's say you're earning 8% on the bond, but you're worried that they might not pay you back. You go to the sovereign CDS market. The sovereign CDS market will sell you insurance. And here's how the insurance will work. Out of the 8% you collect every year from the bond, as a coupon, they'll say, give us 3%. And we'll protect you in case there's default. So it's like a market set default spread. And there's a third way to get a default spread if the first two don't work. Remember those Moody's ratings that I showed you? There are 160 countries for which I can get ratings. There are about 25 that I cannot. We'll talk about those later. But 160 countries which Moody's rates. To the degree that I trust Moody's, and that's a big if, yeah, if I trust Moody's, I can take that rating and tell you what a typical default spread is based on that rating. You're saying too abstract. Let's try this out. So I'm going to try this out on the Brazilian real. I want to get a risk-free rate as of January 1st, 2021 on the Brazilian real. So here's where I started. I looked up the government bond rates in about 30 plus currencies. These are 10-year government bonds in the local currency. You see the Brazilian real? The government bond rate is 7.02%. That's not the risk-free rate in real, that's my government bond rate. My task is to figure out how much of that 7.02% is due to default risk so I can clean it up. So I'll go through all three approaches because all three work with the real. Here's the first one. Latin American countries, almost every one of them issues 10-year dollar denominated bonds. Brazil, for instance, at the start of 2021, had a 10-year dollar denominated bond with a rate of 2.98%. That was the yield to maturity in the bond. It's a dollar denominated bond. And on that same day, the T-bond rate was 0.93%. So that extra 2.05% that you're getting, that's because you perceive default risk in Brazil. That's your first measure of default spread. Take the difference. This works only if you have two bonds in the same currency. Don't compare a real bond to a dollar bond. That's junk. You can't do that. $2 bonds, 2 euro bonds, you can compute the spread. The second approach is to go to the CDS market. And I pull these numbers off at the start of 2021. So these are sovereign CDS. There are about 75 countries now where you can buy insurance. What is it going to cost you? In the case of Brazil, if you look at the number, it's 2.15%. So if you buy into that being the price of risk, that becomes your default spread with one small caveat. If you look at all the countries listed here, there isn't a single country with a 0% sovereign CDS, right? If you trust this market, no country in the world is default free. And that doesn't strike me as right. I mean, where is the default risk in Switzerland? And any of you lend money to Switzerland, you're not lying awake saying, will they pay me? Will they pay? They will definitely pay you. You're saying, so why is the spread not zero for some countries? Because the CDS market has some frictions. It's not, you know, there's counterparty risk. Your insurer might not pay you. There are market structural risks. So here's what I'm going to do to kind of get a cleaner measure of default risk. I took the US, which when I use the treasury rate, I assume there's no default risk. And the sovereign CDS at the start of 2021 for the US was 0.23%. And I said, you know what, that's not a default spread, that's friction. That's a market not doing market problems in there, that 0.23% has nothing to do with default risk. And it's pushing up the default spreads for every other country. You subtract the 0.23% from the 2.15%, what you get as the adjusted number is 1.92%. 2.05% by looking at dollar-based bonds, 1.92% from the sovereign CDS market. Let's give it a third try. Brazil at the start of 2021 was a Ba2 rated country. That was a Moody's local currency rating. And the default spread for a Ba2 bond at the start of 2021 was 2.65%. So I'm going to give you too many numbers here. We know the government bond rate for Brazil was 7.02%. If you take the dollar denominated bond, the spread is 2.05%. If you take the CDS market, it's 1.92%. And if you take the rating, it's 2.65%. You say, which one should I use? I'm going to say something that's going to sound awfully weird, but I'll back it up. Use whichever one you want, but stay consistent.
Is there any merit in using an average of?
You could use an average if you want. You could use a median. But let's work it through. The larger the spread, the lower my risk-free rate becomes, right? So part of you says, let me pick the biggest spread. It's going to give me the lowest risk-free rate. So if I use the 2.65% spread, I get a much lower risk-free rate, which should be 4.37, the risk-free rate, than I do with the other two approaches. So part of you says, let me pick the biggest spread. You know where else this number is going to come back? It's going to come back when we do equity risk premiums. If you decide to pick the biggest number here, it'll help you on the risk-free rate, but it'll push up your risk premium. What one hand will give you, the other hand will take away. So pick a number, whether it's the average, one of these three numbers, I really don't care. Just pick a number and stay consistent. So that's if you have, yeah, go ahead.
I got a question. So
yeah,
did you say the bond rate is the yield to maturity for the first approach?
Yield to maturity is the interest rate on a bond. It's the updated market interest rate on the bond. Because that's what you learn if you hold the bond.
So that's a bond rate?
Well, it is the rate you will earn if you hold the bond. So if that's what you mean by a bond rate, that's what it is.
Okay.
But what is the alternative? What did you visualize as the rate on a bond? I mean,
I'm not sure like whether we should use the expected return or
well,
the actual.
Yield to maturity is the expected return. How do we compute yield to maturity? What do? We take the promised cash flows, we look at the price, and we solve for the internal rate of return. It is an expected future return, right? What other expected return is there in a bond?
Because in core thing, we taught that YTM is the quoted rate, it's a promised rate, and it's like higher than.
Oh, I see. If you have actual default and you take the proceeds and you compute the expected return, we won't use that here. I mean, in a sense, that is good. If we use that, you can't do a DCF, because the minute you do that, you're also assuming your company is defaulted. If it's defaulted, there's no going concern. If there's no going concern, there is no DCF, right? So I see what you mean. That's a good question. It is, in fact, the rate based on promised cash flows, not expected cash flows. So the yield to maturity is what we're going to use. The spread we're charging as bondholders because we're afraid our promised cash flows will not get delivered. Okay. Let's talk about real risk-free rates. Okay.
Professor.
Yep.
I have a question because I know that a lot of valuations, like at firms, they use for foreign companies, they use a country risk premium.
We'll come to that. Hold on. That's separate from risk-free rates. Let's not go down that until we get to equity risk premiums.
Okay.
Right. So. No. So unless you want to connect the question to risk-free rates, do you want to connect the question to risk-free rates?
No, I was just wondering if this was kind of like a substitute for that.
It is actually to prevent double counting, because you're right. That's exactly how people get country risk premiums. And if you don't do this adjustment, you know what's going to end up happening? You're going to double count the risk. You see why you're going to double count the risk? Your risk-free rate is going to be higher because you use the government bond rate, and part of it is default spread. Then you get to the country risk premium, add an extra risk premium, you've double counted for the same reason twice in the same discount rate. So those people at investment banks who had a country risk premium and used the government bond rate as a risk-free rate, I have bad news. You've been double counting country risk. Once through what you call the government bond rate and once through the risk premium.
Thank you.
So let's talk about real risk-free rates. Latin America, for a long time, analysts refused to value companies in the local currency. Why? Inflation was all over the place. So they would do things in real terms. What does that mean? When you project out the cash flows, you make sure you don't count inflation. You use constant prices. Growth has to come from selling more stuff. And the discount rate then has to be a real risk-free rate. And Jonathan and I had this conversation at the very beginning about a TIPS rate. A TIPS rate is a real risk-free rate. Start of 2020, for instance, that rate was 0.4%. But here's the bad news. You're almost never going to do a real valuation in the US. Everything is done in nominal terms. You know where you're going to be doing a real valuation? In Honduras, maybe in Peru, maybe in Brazil, maybe in Vietnam. And I'm going to give you a way of getting a real risk-free rate that is going to be incredibly simplistic, but don't look a gift horse in the mouth. You're valuing a Vietnamese company in real terms, and you want a real risk-free rate. You know what? Just use the TIPS rate as your real risk-free rate. You're saying, but it's a US rate. When it's real, it doesn't matter, right? Because that's what you can earn. And if you assume that capital can flow across countries, real risk-free rates should converge on a single number. So if you're going to do a real valuation, no matter where you do it in the world, just use the TIPS rate as your risk-free rate. So let's summarize. If you have no default-free entity, which was the starting point that we started, I think David raised this point of what if you have no default-free entity? You have three choices. One is you can stay with the local currency and clean up the government bond rate to get to a risk-free rate. The second is you can do things in real terms, to remove inflation entirely from the picture. And here's the third one. You've tried everything you can. You can't get a risk-free rate. You don't trust real analyses. You know what you can do? You can value that company in a different currency. There's nothing that stops you from valuing a Russian company in euros or a Brazilian company in US dollars. If you've tried everything, you cannot get a risk-free rate, perfectly okay. So now let's get back. I forget who it was that asked the question about negative, about risk-free rates being different in different currencies. Let me show you the picture of what risk-free rates look like across currencies at the start of 2021. So you're saying, how the heck do I read this graph? I start with the government bond rate with every currency cleaned up. That's what the red portion of the column is. It's a default spread that I'm cleaning up. What's left, the blue, is the risk-free rate in different currencies. So you ready for the big question? Obviously, risk-free rates vary across currencies. They're high in Zambian kwacha, much lower in the US dollar, and actually negative in euros and Swiss francs. Why do risk-free rates vary across currencies? Joe Peters, why do risk-free rates vary across currencies?
I'm honestly not sure, but why wouldn't price arbitrage balance them out?
That's a good question. So price arbitrage would be borrow at low rates. So borrow in dollars and invest in Zambian kwacha. It sounds like a surefire way to, in fact, this is called the carry trade, which is one of the most absurd and emptiest ways of investing. But you see people do it, right? What can go wrong? What is it that gets, in the way of doing that?
Inflation.
Currency, negative. It's inflation and exchange rates, which are connected at the hip. High inflation currencies have high risk-free rates. Low inflation currencies have low risk-free rates. And deflationary currencies, Emily, help me out here. Deflationary currencies could have what kind of risk-free rate? If high inflation, high risk-free rates, low inflation, low risk-free rates, deflationary currencies could have negative risk-free rates, right? Because if you have deflation, it can happen. So to the question of why would you have negative risk-free rates, the answer is if you have a deflationary currency, it can happen. It's unusual, but it's not unnatural. Which actually gives you an opening to get a risk-free rate in pretty much any currency. A few years ago, I had to value an Egyptian company in Egyptian pounds. And the problem I ran into is I couldn't get a risk-free rate. There's no government bond rate in Egypt. So I said, what the heck do I do? I don't want to give up and do my valuation in US dollars. I wanted to stick with Egyptian pounds. So here's what I did. I started with the T-bond rate. I know you're saying, but that's a dollar risk-free rate. Then I looked up two numbers. One was the expected inflation rate in US dollars. And you can look at past inflation, future inflation predictions. Let's say it's 1%. James, you're going to help me out here. Let's say the T-bond rate right now is 1%. Let's say inflation in the US dollar is also 1%. And inflation in the Egyptian pound is 12%. So what's my risk-free rate going to be in Egyptian pounds? My T-bond rate is 1%. Inflation in the US is 1%. Inflation in the Egyptian pound is 12%. Guess what the risk-free rate is going to be? It's going to be the 1%, the US dollar risk-free rate, plus the differential inflation. The pound has 11% higher inflation. Its risk-free rate is going to be 11% higher. No matter what currency you work with, this will work because adding the differential inflation is going to give you a risk-free rate in that currency. So I don't want to hear anybody say, look, I can't get a risk-free rate in a currency. You can, whether you choose to use it or not is a different question. But you can get a risk-free rate in rubles, a risk-free rate even in Venezuelan bolivar. That's a daring attempt, but it can be done.
Professor,
Final question. Yeah, go ahead. Louis.
How come just for like simplicity and efficiency, you don't just value all companies in US dollars and then at the very end you can just use an exchange rate to...
You could, but
check.
why is it simpler? If you decide to value a Brazilian company in US dollars, what do you have to do? You have to convert all their financials from reais to dollars. You have to take all their past growth rates and make them go from real growth rates to dollar growth rates. The only place where dollar valuation is easy is if all your financials are in dollars. If they're not, doing the valuation in dollars might be easier on the discount rate front, but everything else becomes a huge pain in the neck. Final question, and we'll end for the day, which is,
I have
yeah, go
a
ahead.
question.
Yeah.
Sometimes don't, like, for example, Switzerland set like a negative rate because like they don't want everybody, for example, when there's a crisis to like run to their currency because it's a safe currency.
Remember what we just said, nobody sets rates. How do T-bond rates get set?
By the market.
Demand and supply. Somebody's got to be buying these bonds. You and I can say, I want the rate to be 0.5%. Guess what? If you're the government, you're only one side of the equation. There's got to be people willing to buy those bonds at that rate, right? So Switzerland can't do it, the UK can't do it, Germany can't do it, the US can't do it. You cannot set rates because they've got to be buyers at that rate. And those buyers have to be willing to buy at that rate.
I see. Thank you, Professor.
We're pretty much out of time, so I'm going to stop there. We're a few more loose ends on risk-free rates, but I think you can look ahead, but we'll start with that on Monday. But next session, we're going to talk about equity risk premiums and what they are, how they're measured, why they're different across countries. But that's it, and have a good weekend. And we don't have class on Monday, so you have a week to catch up on your project. By next Wednesday, when I check that Google shared spreadsheet for the class, I hope to see a company name next to each and every one of your names. No more hedging. No more hiding that I'm not sure. I wanted to pick a company, and the sooner the better. So that's your assignment for the next week, is to try to come up with that company you're going to be valuing. So that's it. Take care, and I will see you next week.
Thank you.
Thank you, Professor.
Thank you,
Professor. Have a good week.
Thank you. Professor?
Yes.
Yeah, can I ask a question?
Sure.
So it's on page 41. Can you sort of like explain what's the intuition behind that equation to calculate the risk-free rate of the currency?
The intuition is if you have a government bond rate, it's not risk-free. There's no intuition, right? A government bond rate, if it's risky, has default risk in it. Government bonds are not always risky. So I start with the government bond rate. And if I say it's risky, all I do is estimate a default spread for the government to take out of the government bond rate.
No, I mean, the one used the foreign currency to calculate the risk-free rate of the currency. The
inflation difference. If you ultimately decide that inflation is what causes risk-free rates to be different, if I give you the risk-free rate in one currency, and I ask you for a risk-free rate in a different currency, the only variable that drives differences is inflation. So if I take the difference in inflation between currencies, I should be able to come up with the Vietnamese dong risk-free rate, right? Because all I need is inflation in Vietnam versus inflation in the US. So ultimately, all risk-free rates have an expected inflation component. And to the extent that that inflation varies across currencies, we're just taking that differential inflation.
All right.
Okay.
Professor.
Yes, go ahead.
So with the like the inflation differential, does the fact that like we use our risk-free rate in like the denominator of the equation affect anything? Like, does it like?
No, the same inflation has to be built into the numerator too. So if you decide to use an 8% inflation for Egypt to get your discount rate, remember you control the cash flows, right? And you think about the inflation you're going to build into your Egyptian pound cash flows to be consistent. Guess what you should be building in? An 8% inflation rate into your numerator. That's why it doesn't matter. You could be wrong about inflation as long as you're consistent. It's going to average out. It's going to kind of cancel out. That's why when people spend days figuring out what inflation will be, I say, why are you wasting your time? Because in evaluation, it's not what the inflation is. It's whether you're being consistent in numerator and denominator. That's why we can do real valuations, right? Because you take inflation entirely to zero, you're not helping or hurting the company. You're just artificially removing inflation from both the numerator and the denominator.
That makes a lot of sense. Thank you.
Okay.
Professor.
Yes.
If I'm doing a valuation, a real valuation in reais, could I use the equivalent of a Brazilian tips?
You could, but there's default risk in it, right?
That's minus the default spread.
If you minus the default spread, you could.
Okay. Thank you.
If you're doing the inflation method, do you have to subtract the default risk too?
No, because you're starting with the T-bond rate, which has no default risk in it. Inflation has no default in it. It's just expected inflation. That's the advantage of the inflation method, is you're coming in from the other direction. You're starting with a default-free currency, like the US dollar, to get a risk-free rate. Then you take the differential inflation, you're done. Nothing to net out.
Okay. All right. Thank you.
Oh, go ahead.
Thank you. I have a question regarding when we were asked to choose between the 3-month, the 10-year, and the 30-year treasury bills and bonds. But isn't the liquidity risk for the longer term ones higher than?
But the cash flows are also out there, right? So what's the liquidity risk? So if you have a 10-year cash flow, you want actually a 10-year risk. There's actually less liquidity risk in a 10-year rate than in a 1-year rate. Why? Because you've locked in the rate. The cash flows at the end of year 10. If I use a 1-year rate, I actually have to roll over and get the rate at the end. And I don't know what rates will be 1 year from now. So it's not true that longer term rates are riskier than shorter term rates. It depends on when that's why when you're an insurance company, the safest thing for you to do is take whenever a cash flow comes due and find a bond that matures on the same day, even if it's a 27-year bond. Why? Because you know exactly what cash flow you will get. You can pay off the claim. So the notion of liquidity risk is if you start with a blank slate and say, I don't have a particular maturity, should I buy short-term or long-term? Longer-term bonds do have more uncertainty on the price, but you lock in the rate. Right? So I think it's not clear to me ex ante that one is riskier than the other. It depends on what you're trying to compute the risk-free rate for.
Thank you.
Any other questions? Okay. I will see you next week, folks.
Yeah.